What if the most powerful thing a CEO said this quarter wasn't in the earnings report? It was a single offhand comment about how their business could withstand prices staying low for years. That one sentence, casual as it sounds, just moved markets, spooked lenders, and rewrote the terms of every refinancing conversation happening behind closed doors. We're talking about signaling the art and science of what management says publicly, and how those words ripple through boardrooms, analyst calls, and counterparty negotiations like a stone dropped in still water. It sounds soft, almost psychological, but this is one of the hardest economic forces you'll ever try to measure. Here's the machine running underneath it all. When a company's leadership speaks publicly, they're not just talking to shareholders, they're negotiating with everyone simultaneously. Lenders, rating agencies, competitors, and regulators, all at once, whether they mean to or not. Think of it like texting your landlord that you totally don't need this apartment. Suddenly your leverage just evaporated. The optimism was real for a while, and the headlines were glowing, management teams projecting strength, analysts nodding along, and refinancing desks, extending generous terms because confidence was the prevailing currency. Then the macro environment shifted. Commodity prices softened, and those bold proclamations started aging the way milk ages in a warm car. Now investors are squinting at old press releases with the energy of someone rereading text from an ex, asking themselves whether resilient business model meant something specific or was just vibes. The psychological whiplash of watching certainty curdle into uncertainty is brutal, and it changes how every future statement gets received with a little more skepticism, a little more side-eye. History is absolutely littered with examples of executives who spoke too confidently, too early. Remember the energy sector in 2015? When CEOs swore their balance sheets were bulletproof right before the write-downs started piling up like rush hour traffic. The pattern repeats because human nature repeats. We overestimate our resilience in public because weakness, even honest weakness, gets punished immediately by the market. Here's a cycle in one sentence. Companies signal strength to protect valuations, lenders price off that signal, then reality eventually arbitrates the gap, and everyone pretends they saw it coming. What's fascinating and a little maddening is that the signal itself becomes part of the fundamental, changing the actual outcome it was only supposed to describe. The misconception most people carry is that public optimism is just spin, harmless noise that sophisticated counterparties see right through. In reality, lenders and rating agencies often anchor their models to management guidance, meaning a confident statement about low price tolerance can literally lower your borrowing cost until it can't. The regulatory angle is where it gets genuinely spicy, because securities law cares enormously about whether public statements are materially accurate at the time they're made. If you tell the market you're comfortable at $40 a barrel and you're privately stress testing at 60, you may have just invited the SEC to your next strategy meeting. So what do you actually do with this, practically? You listen to management statements not as facts, but as negotiating positions. And you ask the secondary question, who benefits from this narrative being believed right now? That one analytical frame will protect you from more bad decisions than almost any financial model you'll ever build. The disciplined move, whether you're an investor, a counterparty, or just someone trying to understand a company's real position, is to track the delta between what was said and what happened quarter over quarter, because pattern recognition over time beats conviction in any single statement. Size your exposure accordingly, keep emotion out of it, and remember that even honest management teams can be spectacularly wrong about their own resilience. At the philosophical level, what we're really talking about is the relationship between language and reality in capital markets, and the uncomfortable truth that sometimes saying something loudly enough makes it temporarily true. Words have collateral value, and that collateral gets marked to market eventually. The irony is that the companies that communicate with the most nuance and honest uncertainty often build the most durable counterparty relationships. Because sophisticated capital doesn't want bravado, it wants to know you've actually stress tested the downside. Confidence is currency, but credibility is the reserve currency. And you can only print so much of the first one before the second one starts to devalue. Whatever the outcome of any particular company's signaling strategy, the lesson for all of us is the same. Process beats conviction, positioning beats prediction, and the market will always eventually read the fine print. Whether you're evaluating a company's management team, structuring a deal, or just trying to understand why a stock moved on, words alone, rational preparation for multiple outcomes will always outperform betting everything on one narrative. And if you're ready to put disciplined, clear-eyed thinking to work in your own financial journey, whether that's real estate investing, home contracting, or connecting with the right lenders, check out our links in the description below.